Analyzing a change in the growth rate of the money supply turns out to be a little more complicated than just an increase in the money supply itself. So the difference is an increase in the money supply would look like this. And that's the case we've been considering. An increase in the money supply growth rate doesn't jump up, it looks like that. And it turns out the difference matters a lot for our analysis. To start with, notice that the money supply itself didn't increase much at the time this policy change took place. It takes me probably several months or years to get to the new higher level that happened here. So the first piece to notice is that on impact, not much changes on the money supply side. The second thing is, we know that over the long run, this growth rate of money supply translates into percentage change in price level, which is inflation. So it does mean that although not much changed in the money supply today, the growth rate over time will lead to higher inflation, which will lead to higher interest rates. So one thing that definitely happens from all of this is we get higher expected interest rates immediately, and that is going to increase money demand. So we also break from just having a short run and a long run analysis. The timing here gets a little tricky. So what we'll break it into is an impact effect. This happens as soon as this policy change is credibly announced. Credibly announced policy change. The credible just means the central bank came out and said, we're going to do this, and everybody believed them. Okay? It's a whole other more complicated thing if they announce this and nobody believes them. That's a different matter. So let's imagine the central bank announces this. On day one right here, they announce it, everybody believes it, and as a result, it increases the expected interest rate, which increases money demand today. The short run effect is going to be, as time continues to creep forward, there is some small increase in the money supply every month or quarter or whatever we're looking at. So these are small increase in money supply, but there's sort of a long run effect too, that the increases in the money supply get offset by increases in the price level. So I'm going to try and put all of those into a couple of diagrams, and then it's easiest to see in time paths. So we start by labeling our graph. On impact, this is announced and believed. Everybody knows that future inflation will be higher, future interest rates will be higher, and that shifts this out to the right.